The national debt has been getting much attention lately, especially with the elections coming up this November. It's a real worry because it shot up during the COVID-19 pandemic. In 2018, the debt was $26.14 trillion. By 2023, it had jumped to $33.17 trillion. Now in 2024, it is a massive $35.7 trillion. Things have gotten so concerning that the top 3 credit agencies have downgraded the US government's long-term debt rating. This means the country has a worse credit score than big names like Microsoft and Johnson & Johnson, even though, unlike the government, these companies can't just print more money. The US national debt is now bigger than the entire economy, and it's only expected to keep growing. So, what does this mean for investors? This video will explain why, as an investor, you should care about the national debt and what can be done to reduce long-term risks. Why investors should care about the national debt. The national debt might feel as distant from your investments as your parents' debt is from your bank account. But just like how your parents' debt can eventually affect you, if the government's budget deficit keeps growing, it could start hurting your everyday life and your investments. To clarify, the national debt isn't the same as the deficit. The debt is the total amount the government owes, built up from years of deficits. Right now, it's more than $34.5 trillion, which comes out to over $103,000 for every person in the US. Back in 2021, that number was $84,000 per person. The deficit, on the other hand, is the gap between what the government makes, mostly from taxes, and what it spends on things like defense, healthcare, education, and other services. When the government spends more than it earns, that's when we get a deficit. And these deficits add up, contributing to the national debt. So why has the national debt gotten so large in such a short time? The national debt and deficit have shot up in a short time because the pandemic slowed down the economy, causing a brief but severe recession. To manage the crisis and help the economy recover, the government increased its spending by about 50%. The US government is limited in how much money it can borrow to fund its operations, a limit known as the debt ceiling. Congress holds the authority to raise or suspend the debt ceiling as needed. Over the years, Congress has done this many times to keep up with budget priorities. Failing to adjust the debt limit would lead to the government defaulting on its debt obligations. Since 1960, Congress has raised or suspended the debt ceiling 78 times. The most recent change was in June 2023, when Congress voted to suspend the ceiling until January 2025. The economy isn't going to crash tomorrow because of the national debt, says David Primo, a professor of political science and business administration at the University of Rochester and a scholar at George Mason University's Mercatus Center. But it's a long-term issue, and we should start planning for how to handle the massive rise in debt caused by the pandemic. The national debt's rapid growth is not just a governmental concern. It directly impacts financial markets, and as an investor, it's something you can't afford to ignore. With deficits piling up, it's important to know how this could influence your future financial decisions. The national debt's impact on investments. Investors need to be aware of what rising national debt means for the future of the economy and financial markets. The more the government borrows, the more it can lead to higher interest rates and lower returns from the stock market. When the US government issues more Treasury securities to fund its deficits, it increases the supply of bonds. When that happens, investors typically ask for a higher interest rate to compensate for the added risk that comes with lending to a more indebted nation. Government bonds, while useful for cash preservation and providing a fixed income, carry something called interest rate risk. Bonds and interest rates have an inverse relationship. So, as interest rates go up, new bonds that offer higher yields become more attractive, which lowers the price of existing bonds with lower interest rates. This fluctuation can directly impact an investor's portfolio if a big portion is in bonds. The Federal Reserve, while controlling short-term interest rates via the federal funds rate, has less control over the market-determined rates paid on Treasury securities. These securities are sold at auction, and their rates are heavily influenced by market demand. One closely watched rate is the 10-year Treasury yield, which is considered a benchmark for many other financial products, like mortgages and student loans. When these rates move up, it tends to pull long-term rates higher for consumers as well. That means everything from mortgage payments to car loans could get more expensive. For investors, as debt continues to pile up, it leaves them with less money to invest. As their disposable income shrinks, the magic of compounding, the process of growing wealth over time by reinvesting profits, becomes difficult to realize. With fewer dollars flowing into investment markets, opportunities to grow wealth naturally become limited. When it comes to stocks, the 10-year Treasury yield is often considered the risk-free rate of return. This is the minimum return you can reasonably expect without the US government defaulting. As the 10-year yield climbs, stock market valuations tend to face downward pressure because stocks are considered riskier than bonds. Investors start demanding higher returns to justify the risk, which often means that stock prices may need to fall to offer the necessary return on investment. So, as bond yields rise, the stock market often becomes less attractive, putting pressure on stock prices to decline or stagnate. Debt also affects consumer behavior. The larger the national debt, the bigger a slice of the budget it consumes. As debt servicing costs rise, consumers are likely to feel the squeeze. When people start spending less on goods and services, company revenues tend to decline. This can negatively impact the profits of businesses you may have invested in, ultimately hurting your stock portfolio. Moreover, rising national debt could eventually lead to more aggressive tax policies, as the government seeks to raise funds to pay off its obligations. If taxes increase, investors may see their net returns shrink, further dampening the overall investment climate. So while the national debt may seem like an abstract issue on the surface, its consequences are very real and personal for investors. Maintaining balance in the short term. Before you start to worry, it's important to understand that this is a long-term issue and one that is not likely to explode in the near future. For over 40 years, people have been warning that US fiscal problems are unsustainable. Yet, during all that time, these issues have persisted, and the US economy has continued to grow, with financial markets generating positive returns. Bond financing markets serve as a good sign that there isn't an urgent problem on the horizon. Most bonds are funded through repurchase agreements, which are short-term loans backed by bonds as collateral. U.S. Treasuries are the preferred choice for collateral among lenders, making these repo lenders a good indicator of U.S. credit risk. Right now, these lenders are feeling optimistic about the situation. Given this positive sentiment, there's no reason for investors to change their portfolios significantly. Continuing to worry about a potential U.S. debt crisis may lead to below-average returns. History suggests that the economy will keep chugging along, so sticking to a well-thought-out investment strategy is likely the best approach for the time being. But still, one concern is mitigating long-term risks. And it all depends on how the government handles the debt situation. The way policymakers and monetary authorities work together to tackle the growing national debt is important. Whether they decide to raise taxes, cut spending, or implement more quantitative easing, each of these choices could affect confidence in the stock market. If you're not as optimistic as others about the situation, there are steps you can take to lessen the impact of rising national debt on your investments. One option is to invest in real assets like commodities, real estate, or Treasury inflation-protected securities, TIPS, to guard against inflation. Inflation becomes a worry because if the government chooses to pay off its debt, it might do so by printing more money. When more money is in circulation, the value of each dollar decreases. Municipal bonds are another good investment choice. State and local governments have borrowing limits that help keep their debt levels in check. These bonds are generally safer than corporate bonds and are often exempt from federal taxes. If you buy bonds from your home state, they may even be exempt from state and local taxes. You don't have to completely avoid the stock market either. The stock market often focuses on short-term gains and may overlook the long-term debt issue. Since rising debt is a longer-term concern, it might not be an immediate worry for the stock market right now. In short, the national debt is a pressing issue that deserves the attention of every investor. While it might seem distant from your day-to-day finances, the implications of rising debt can directly affect your investment strategies and the overall economy. Understanding the nuances of how the national debt and budget deficits interact helps you make informed decisions about your financial future. As the U.S. grapples with its growing debt, it's essential to stay proactive. By diversifying your investments and considering options like real assets and municipal bonds, you can better safeguard your portfolio against potential risks. While the immediate future may not show signs of a debt crisis, remaining vigilant and adapting your strategy will position you to navigate whatever economic challenges lie ahead. Ultimately, keeping an eye on the national debt and its effects on financial markets is not just prudent, it's essential for building and preserving your wealth. By staying informed and ready to adapt, you can ensure that your investments continue to thrive, regardless of the economic climate.